conference is being recorded.
Gentlemen, I am Rajita, the moderator for this conference. Welcome to the Indus Towers Limited first quarter ended June 30th, 2022 earnings call. For the duration of the presentation, all participant lines will be in the listen-only mode. After the presentation, the question and answer session will be conducted for all the participants on this call. In case of a natural disaster, the conference call will be culminated post an announcement. Present with us on the call today is the Chairman and Independent Director of Indus Towers, Mr. N. Kumar, along with the senior leadership team of Indus Towers, Mr. Bimal Dayal, MD and CEO, Mr. Vikas Poddar, CFO, and Mr. Dheeraj Agarwal, Head Investor Relations. Before I hand over the call, I must remind you that the overview and discussions today may include several forward-looking statements that must be viewed in conjunction with the risks that we face. I now hand over the call to our first speaker of the day, Mr. N. Kumar. Thank you, and over to you, Mr. Kumar.
Thank you, Rajita, and good afternoon, and a warm welcome to each one of you to the earnings call of Indus Towers for the quarter ended June 30th, 2022. It's my pleasure to speak to you as it is the first time I've joined you all over the earnings call of Indus Towers. As you're all aware, the industry is at a watershed moment with the imminent rollout of the 5G services in the country. As one of the largest passive telecom infrastructure players, we are well equipped to cater to this demand and support our customers for their rollouts. I'd like to take a moment now to appreciate Team Indus on the commendable job they have done in maintaining our leadership position during difficult times too. On behalf of the board, I'd like to thank Bimal Dayal for his contribution to the growth of Indus Towers. The last 5 years have indeed been tough for the industry, and the quarter gone by wasn't an easy quarter either. Bimal has successfully navigated the company through these tough times. Under his stewardship, Indus has managed to scale new heights and achieve key milestones. You're all aware we completed an impeccable merger in the middle of a pandemic. Bimal has built a culture which has made the company a great place to work as recognized by the Gallup for 9 years in a row. He now leaves the company in great shape with a strong management team in place. I take the opportunity of wishing him the very best in all his future endeavors. I'll take the opportunity of handing over the call to Bimal to present an update on the quarter ended June 22 and answer all queries. I will now exit the call and over to you, Bimal. Thank you.
Thank you. Thank you very much, Mr. Kumar. Good afternoon, everyone, and thank you for joining us on the earnings call of Indus Towers for the quarter ended 30th June 2022. Joining me today are my colleagues Vikas Poddar, CFO, and Mr. Dheeraj Agarwal, Head Investor Relations. Before I begin our agenda today, I would like to take a moment to acknowledge the heroic efforts and dedication of our field force in Assam, who battled the heavy rains and floods to make sure that the network does not go down. I'm immensely proud of their efforts to ensure connectivity under the challenging circumstances. At the beginning, let me say that our business fundamentals remain stable and have improved this quarter given the recently concluded 5G auctions, the exploding data growth, and the agreements on the Msa Renewal framework, besides our improved operational performance. I'll touch upon each one of them one by one. Coming to the 5G auctions first, the telecom industry is at the cusp of the next phase of growth as it moves closer to paving way for high-speed 5G services to public and enterprise. In line with the government's plan for rapid rollout of 5G services in the country, the DoT concluded the entire auction process for 5G spectrum within a short span of time. The changes in the reserve price and payment schedule and availability of enough spectrum were key to the successful auction, which saw active participation from at least 2 telcos. The telcos acquired spectrum across bands including 3.3 GHz and 26 GHz band, which are important for 5G services. The Government of India has received a total bid amount of whopping 1,53,173 crores with 51,235 megahertz sold out, spectrum sold out of the total of 72,098 megahertz spectrum on the offer. Also, this is the first time we saw the bidding on 700 megahertz as well, which is significant change from the previous auctions. The acquisition of 5G spectrum in conjunction with government's encouraging stand makes us feel optimistic about swift proliferation of 5G services in the country. Indus Towers is geared up to support the 5G requirements of the operators based on their rollout strategy. Well, the auctions are on one side, but there are great tailwinds in terms of 5G adoption as well. Global trends of 5G adoptions are quite positive as evidenced by the statistics mentioned in Ericsson Mobility Report. As per the report, global 5G subscriptions grew by 70 million in March quarter to 620 million and are expected to reach around 4.4 billion by the end of 2027. Additionally, the number of commercial 5G service providers also increased from 200 in December 21 to 210 by March 22. The report also estimates that 5G penetration in India will reach 40% to 500 million subscription by 2027. This was about the 5G story. However, the inherent demand which comes from data consumption by the large Indian customer base remains robust. The total data consumed across top 3 operators combined grew by a healthy 36% year-on-year in Q4 FY22. The average data consumed per user per month across top 3 operators at more than 18 GB in Q4 FY22, exhibiting a year-on-year growth of 30%. The rapid growth in data consumption coupled with continued migration to 4G and 5G is expected to drive the demand for passive telecom infrastructure, and we are very well positioned to cater to this demand. Another thing of immense significance to us is the Msa Renewal. We are pleased to inform you that revised framework has been agreed with both our major customers. The renewal of co-locations will provide us with long-term revenue visibility from a substantial part of our portfolio for the next 10 years. As we highlighted in the last quarter, we have offered competitive rates to our customers under the revised framework. I would like to add that both customers have agreed to renew majority of their sites expiring between March 22 and March 23. They retain the option of exiting up to 9% sites without exit charges or renewing all or part of these sites at a future date. Vikas will be sharing further details later. From an operational performance standpoint, we had an improved quarter. During the quarter, we had additional net additions of 1,027 towers and 591 co-locations. These numbers do not include addition of lean towers and corresponding co-locations. Net additions were impacted due to higher churn in co-locations at 733. Our total towers and co-locations at the end of Q1 were at 1,86,474 and 3,36,382 respectively, each growing by 5% and 3.4% year-on-year basis. Sorry, we are getting some echo.
to 33.7%. The EBITDA numbers were lower due to a substantial increase in provision for doubtful debts, which is recorded under other expenses. As per our accounting policy, when our receivables are overdue beyond a threshold, we need to make provisions for doubtful debts. And we also write back or reverse those provisions as and when we are able to collect those aged receivables. We have made provision for doubtful debt of rupees 12.3 billion in this quarter due to delay in payment from a customer beyond the threshold period. Adjusted for exit revenue, the provision for doubtful debts, and the provision reversal, EBITDA was up 2.9% year-on-year and down 0.8% quarter-on-quarter. Our energy margins continue to be negative. Quarter 1 was impacted by seasonality as our diesel consumption increases during this period, which was partly offset by the lower provisions on account of revision in our estimates that we usually do in the first quarter of every year. We continue to take initiatives towards reduction in diesel consumption to minimize the energy loss. Our reported profit after tax was down by 66.3% year-on-year and 73.9% quarter-on-quarter to rupees 4.8 billion. Again, adjusted for exit revenue, provision for doubtful debts and provision reversal, our profit after tax was up 2.9% year-on-year and down 4.7% quarter-on-quarter. Our cash flow from operating activities for the quarter was rupees 18.7 billion in quarter 1 FY23 compared to rupees 19.6 billion in quarter 1 FY22. Our free cash flow for the quarter was at rupees 5.5 billion, which was impacted by the delay in payments from one of our major customers. Our reported pre-tax return on capital employed and post-tax return on equity for the past 12 months were lower on both year-on-year and quarter-on-quarter basis to 22% and 29.5% respectively. Let me now spend time on explaining the developments on co-location renewals and receivables. On the co-location renewals, I would like to inform you that we have established a renewal framework with our customers that includes a discount on prevailing base rates of the renewal portfolio to maintain our competitiveness and continued business relationship. As a result, we have secured renewal of majority of the co-locations expiring between March 22 and March 23 for an extended period of 10 years. The revised rates on these renewed co-locations will come into effect on their respective renewal dates starting from April 1st of this financial year. The revised rates are estimated to result in a marginal reduction in the revenue per quarter on Ind AS 116 basis. We believe that the financial impact of the discount would be offset by incremental revenue from future rollouts by the customer for their network expansion, the launch of 5G services and other network solutions. Moreover, securing a 10-year extension on the renewal portfolio provides a long-term certainty and visibility of core revenue. Next, I would like to apprise you of the receivable situation. Our reported trade receivables decreased by rupees 8.1 billion due to provision for doubtful debt of rupees 12.3 billion, which is accounted in the other expenses. While the customer has expressed that it is closer than ever to tying up its financing needs and also considering the fact that there has been positive development recently, including its participation in the 5G spectrum auction, we have nevertheless considered the current situation and adopted a more stringent accounting practice for making provision for doubtful debts in respect of dues recoverable from the customer. Adjusting for this provision, increase in trade receivables would be rupees 4.2 billion due to shortfall in the payment by the customer. I would like to reiterate what Bimal said, that the receipt of the payment from the customer remains challenging in the short term. The customer has proposed a payment plan wherein they have conveyed the ability to pay part of the billed amount till December 22 and 100% thereafter, along with clearance in a phased manner between January 2023 and July 2023 of the old dues that would accumulate till December 2022. We are engaged with the customer to work out a better payment plan. Hence, we expect to see gradual improvement in our trade receivables position that we will continue to monitor very closely. In summary, we had a mixed quarter wherein our financials reflect the stress placed on them by the collection issues from one of our major customers. We are hopeful of navigating our way through this situation, given the long-term growth story of the telecom infrastructure space remains robust. I would now like to hand over the call back to Bimal.
Thank you. Thank you, Vikas, and happy to take questions. Over to you all. Over to you, Rajita.
Thank you very much, sir. We will now begin the question and answer interactive session for all the participants who are connected to the audio conference service from Airtel. Due to time constraints, we would request if you could limit the number of questions to 2 to enable more participation. Hence, management will take only 2 questions per participant to ensure maximum participation. Participants who wish to ask questions may please press star 1 on their touchtone enabled telephone keypad. On pressing star 1, participants will get a chance to present their questions on a first-in-line basis. To ask a question, participant may please press star 1 now. The first question comes from Mr. Pranav Kshatriya from Edelweiss Securities, Mumbai. Mr. Kshatriya, you may ask your question now.
Thanks for the opportunity. My first question is regarding the impact of Msa renegotiation. You talked about decline in the revenue because of this. So can you quantify how much will be the impact, in terms of the rent per tenancy compared to the previous quarter? Of course, adjusted for that 5.5 billion one-off which was there. That's my first question. And secondly, how should we see the financial impact of, the no exit charges for 9% of the tenancies? Because I assume that, they would want to execute, higher, basically churn out higher tenancies. Will that have a revenue implications, or it will have, other cost implications because you might have to close certain towers because of that? So how should we see this impacting, revenue/profitability? Those are my 2 questions, and thank you.
Thank you, Pranav. I'll take the second one first on this 9% and the impact thereof. I think if you actually look at over a period of 10 years, there have been a lot of 10, 12 years, I would say there has been a lot of, let's say, scope for optimization which has been built into whatever we end up doing as well. So this could be the landlord rentals, this could be energy costs, etc., etc. And I think over this period, there is some amount of towers which, let's say, we would like to exit, or let's say jointly between our customers and us, we would certainly like to work upon those costs as well. However, I think this number in reality would be much lower than 9%. This is more flexibility which is existing with the customers and us as well. I think there are certain incentives which, let's say, the customers has, wherein the costs are higher, and this actually puts a very good pressure on towerco like us to bring those costs down for some amount of such towers as well, and we are working with the customers. Now, we certainly would like to give you a color as to impact of this 9%, and since we have kind of closed these MSAs very recently,
now.
Yeah, thanks for the opportunity. Again, a question on Msa Renewal. Any other changes in the terms such as annual escalation which you're getting, which is about 2.5%, does that stay, and whether there is any change in terms such as loading?
So thanks Kunal for this question. There's no change when it comes to our annual escalation or the loading charges as well. So it remains the same.
Okay. And the second is operators acquired 5G spectrum. Can you run us through what kind of upside you can see from that, purely from loading, not from say new towers, but on loading, assuming that the tenant goes for say 50,000 1 lakh sites on which they deploy 5G services. What kind of an upside would you expect from that?
So look, this also depends in Kunal. If I understand your question right, you are actually trying to look at what kind of an impact 5G will have on Indus. Start with the loading charges. So let me say first of all that I think operators' strategy would vary from let's say one customer to the other as well. And let's put it this way that initial responses which we have seen, I think we will see large-scale rollout of 5G on our existing sites as well, and which would start almost in weeks time from here on as well. I think we've been working on preparing these sites for quite some time now as well. I think each one will have different radios and different antenna sets as well. However, only color I can give you is where we stand is the average loading for 5G is going to be higher from what we actually realize on 4G as well. And I think for at least first year with massive rollout, I think we really expect to do very well when it comes to our loading revenue on 5G. However, I think per site basis, it will depend on customer to customer as well and the kind of equipment which comes in.
Thanks for that. So in 4G, if I'm not mistaken, it used to be about 10%. Is that the kind of number you indicated, like the number in 5G will be higher compared to that? So is that the right way of looking at it?
Look, I'm only saying it will depend from customer to customer as well. On an average, we have seen that this is higher. Now, what will the customers do to optimize this as well will actually happen when this rollout begins as well. In our trials, this is what it is right now. I won't be able to kind of substantiate this for you until the first rollout start to take place. That would be a good time to ask this question. But my take from whatever we have seen, on an average, this is going to be higher than 4G for sure.
Sure. Thanks. Just one small question. Will this issue have any impact on the dividend distribution strategy, dividend payout, which you are looking at? That's it from my side.
Kunal, I'll take that one. I think, like I said, I mean, our dividend policy has not changed. It still remains linked to the cash flow. So hopefully, we will keep evaluating the cash flow situation of the company, and we will stick to the policy. If there is any excess cash flow, we would be happy to sort of distribute that out. So we will keep evaluating, and then we will see whether that goes.
Thank you. Thank you, Kunal.
Thank you.
Thank you very much, Mr. Vora. The next question comes from Mr. Vivekanand Subbaraman from Indus Capital, Mumbai. Mr. Subbaraman, you may ask your question now.
Hi, thank you very much for the opportunity. Unfortunately, my questions are on the same two issues that got discussed before. So on renewals, I'm trying to understand this better. So you said that through the year there will be co-locations that will come up for renewal, and therefore the new rates will kick in. So there will be a QOQ revenue reduction. Is that understanding correct?
Yeah. So we have all the co-locations that would, I mean, bulk of it was due to renew in March 2022. But even in the next 9 or 10 months, we will have the co-locations that will come up for renewal. But bulk of it has already got renewed as of 1st April. So there will be small portions that will keep coming up, and we will basically apply the new rates as and when they come up.
Okay, so extending this a bit more, you would definitely have some tenancies that will come up for renewal perhaps in 2023 and 24 from the two large operators. Does this mean that you have to negotiate for those tenancies again, or will the same conceptual framework be applicable in subsequent years also when those respective co-locations come up for renewal?
So, Vivekanand, right? This same framework will be applicable to the tenancies which will come up for renewal in the future as well. So I think whatever we have right now, the understanding is this is for the tenancies which are coming in for renewal and the future tenancies as well.
Great. And so could you help us understand what percentage of the co-locations from these operators come up for renewal in fiscal 24 and 25? Any broad ballpark will help.
So I do believe that a bulk of it would be behind us or is behind us in the current and the coming fiscal year. I think maybe offline we can share through Dheeraj what kind of staggering we have for these tenancies in the coming years as well.
Understood. And the last one, which is on receivables. So if I understand correctly, we had a payment plan from Voda Idea. We announced this on 22nd Feb. So from then to 15th July, there was a certain committed payment. Can you help us understand if this committed payment for this period, Feb to July, covered the billing that you had from Voda Idea, or was it significantly lower? I'm trying to look at it from the perspective of a new payment plan that you are trying to arrive at with Voda Idea.
Yeah, sure. I'll take that one, Vivekanand. I think the payment plan that we had agreed back in February had two parts. There was the first part, which was linked to the primary pledge or the security that we had, which we sort of supported the restructuring, and as a result, that was monetized by the promoter and routed back to VIL, and then it was basically used to pay our outstanding. So that was the first part, and then there was a second part wherein we had a minimum commitment of 3,000 crores in that period. So both these parts basically covered our billings in that period, and that got over on 15th July, and that's when we reached out for a new payment plan for the future.
Okay, and by when do you think you will be able to conclude the new payment plan, the one that you described where we
Prasad, you may ask your question now.
Thanks for the opportunity. You said that in 5G, loading will be relatively higher as compared to 4G. Can you fundamentally explain why fundamentally that should be the reason? Is it because of the higher power output of the 5G RANs or the rates or the antennas bigger? Can you just explain a little bit on that?
So I think major, if I remember it right, the major loading is coming from the power requirements as well, and also the antennas which would go up as well. I think it is the power requirement which actually will alter the loading or get us the bulk of the loading as well.
Okay. So that means that we also need to, from as a tower co, we also need to upgrade our facilities on, say, battery or a DG infrastructure side to support the higher electrical load?
That's correct. And all this depends on the condition of the site as well, whether we have headroom or whether we need to improve the site condition to match the load requirements as well, and that's an ongoing exercise as well. I don't think I would possibly be too worried about that part.
Understood. And second question is on lean towers that we are talking about. Is the understanding correct that going forward we will be only deploying the leaner towers and not the traditional ones we used to deploy earlier? Is it what we have agreed with the customer as well?
No, I don't think that's the understanding. Leaner towers provide, a limited loading opportunity as well. Every product which we actually put up has its own applicability, after which the other product kicks in as well, and I don't think there is a cannibalization which takes place as well. Hence, wherever operator has to put a heavier site which has loading requirements higher than the leaner one, I think the next level of site kicks in. So I don't think it would be right for you to conclude that only leaner sites will be installed. Yes, at the moment we are seeing very good traction from the customers to build the leaner sites as well. And I think we have also improved upon cost structure of this tower as well, which is fitting in the bill for a faster rollout as well.
Okay, just to understand a little bit more, is the leaner tower is a solution offered by Indus because one operator keeps expanding and another operator is not putting enough capex or not giving any orders? So in order to minimize the capex, we go with the leaner towers. Is the understanding right, at least?
Well, it's a product in itself, and if we go back in time, when we used to make single tenant sites, we were not even recovering, we were negative. With leaner towers, we make reasonable money as well, and it's not a money losing venture as well. So it's a good thing. While we roll it out for one customer, I think we do believe that it would also provide a good takeoff path for our next customer as and when the customer wants to deploy sites on similar rooftops as well. So I think it fits the bill for us in a very good way, and it fits the current scheme of things as well, in which we have asymmetric rollout taking place between the operators.
And whenever the other operator is ready, how will we accommodate that operator in the leaner towers? Do we have a pathway for that, or it's something that we are yet to finalize the scope?
This depends from site to site as well. But I think one of the biggest things which happens in acquiring any site is the physical acquisition of the site. Rest is around the electrical and let's say the physical towers as well, which is a easy and doable thing as well. So once you acquire an area, I think the hard part is done. Rest is really fixable for the second operator as well, which is our core business. So we are, all I can say is with even leaner towers being rolled out, we are ready for the second operator depending on, the condition of site to site as well.
Very helpful. Thanks.
Thank you very much, Mr. Prasad. The next question comes from Mr. Manish Oswal from Nirmal Bank, Mumbai. Mr. Oswal, you may ask your question now.
Yes, sir. Thank you for the opportunity. I have only one question with respect to the provision for one of our telecom customer. So up to June 30th, 2022, we have taken the most of the provision, or how the provision line with respect to this thing will move forward in coming quarters. Can you guide us on this front?
Yeah, sure. Basically, like I said, because of the risk that we have within our accounts receivable, we have adopted a more stringent provision policy, and as a result, we have made a provision. Now, going forward, like I said, we are sort of engaged and discussing a better payment plan. The current commitment that we have indicates, a part payment of the bills till December 2022. If that happens, then that would mean that the receivables would probably worsen a bit more before we start seeing improvement, in which case there might be a situation where we will have to provide more to sort of keep managing the risk of account receivable. So, I mean, we have to really monitor this very, very closely, assess the situation, and see how we decide on this one.
Sure, sir. Thanks a lot.
Thank you.
Thank you very much, Mr. Oswal. The next question comes from Mr. Praful Kumar from Diamond Asia Capital, Singapore. Mr. Kumar, you may ask your question now.
Hi, thanks for the opportunity. I'm audible?
Yeah.
Sir, just two questions. First, in terms of now 5G rollout, I'm sorry I'm harping on this again. Can you just explain a bit more how this is a bigger opportunity for us in terms of revenue growth? So is it that more products are being demanded by the operators, or how exactly is the value add that we do in this rollout?
So you have two questions, Praful. Would you like to ask the second one as well, or?
Yeah. Your second question is I think, extension of the previous one. Can you explain a bit more on why, receivables, you are taking a write-off and you think it would be a big worry? Because if the third operator is being now government guaranteed, so what exactly is the problem here in terms of underlying cash flows? What exactly is the problem here?
So, Praful, I'll give two comments on what you just mentioned. One, government guaranteed, and second, write-off. I don't think there is a write-off taking place, or second, there are government guarantees here as well. Technically, I would like Vikas to answer this question on receivables. I'll take the 5G rollout subsequently. So please.
Yeah. So Praful, I think the rationale is the fact that we have a very aging receivables, while there is a payment plan in place which gives us the visibility of eventually collecting all the dues. But at the same time, we have the account receivable that's aging and very concentrated with a large amount. And hence, as a prudent approach, we have decided to provide so that, we are managing the risk very well. So I think it's like Bimal said, it's not a write-off, it's just a provision. And there is no government or a sovereign guarantee behind this. This is purely a commercial outstanding that's there.
Just to add a little bit more color on, I think we've been talking about this receivables. I think please look at it this way, that we also have been in our discussions with the customers, we have been told that we will not be worse off when it comes to the payments made on a percentage basis by our customers, which actually on an extrapolation tells us that we are kind of not the only ones in this entire ecosystem. Hence, we all are actually eagerly looking forward to, I think, the financial package which is being spoken by our customer as well, and those closures basis which they have given the payment plan as well. I do believe that since you brought out the government, I think in public domain information, it is very clear that the customer is also waiting for the equity conversion as well. And I think that's where you actually mentioned the government guarantees, but I think that thing has still not happened, if I remember it right as well. So I think few good things have to actually take place before the whole thing starts to fall in place as well, and we are eagerly waiting or watching this. On the 5G side, we do believe that this time the enthusiasm and the strategy from the customers is certainly going to be slightly different than what we've seen in the past. If you actually go back to some of the strategy which, let's say, operators adopted when 3G was rolled out or even 4G was rolled out initially, I think we actually took a hotspot approach, or we used to wire up areas where the traffic is supposed to be higher, and we used to have this concept of hotspots as well. And then we saw a mighty rollout of 4G, and everybody started to look at a wide brush approach towards peppering up the entire country with 4G. Now, 4G has taught us a lot of lessons as well, and we do believe that there will be a very quick proliferation of 5G on our sites itself, and we will see huge amounts of rollouts coming up on our existing sites. As I mentioned, the per site basis as well, we will probably have revenue which is higher than what we derive out of 4G, but remains to be seen what the operators end up with as well. Hence, this is what gives me the backing of what I'm saying, that it would be significant for us in, let's say, next 12 to 18 months as well, before the next phase of 5G kicks in, which will be occupying the space which makes us even more relevant, which means the ultra low latency networks as well. I think initially we will have the massively broadband proliferation of 5G, and then later on we will see the ultra low latency networks coming up as well, which will occupy the street furniture much more, wherein we become even more relevant as well. So that actually tells me 18 months with a huge amount of rollouts of 5G on our existing sites. Post that, I think we will certainly see low latency coming up as well. So it's a good thing for tower industry.
Got it. Thanks a lot.
Thank you.
Thank you very much, Mr. Kumar. The next question comes from Mr. Varun Ahuja from Credit Suisse, Singapore. Mr. Ahuja, you may ask your question now.
Yeah, hi. Thanks for the opportunity. I just want to ask two questions, and obviously those are related to two big things. One is the rental negotiation, and also on the receivables. First, on the rental negotiations, can you give some clarity on it? Because the last time when it happened, I think there was a detailed presentation over there, and the attempt was that in future, whenever the negotiation will happen, or the renewals will happen, rather the right term, the older and newer tenancy will be at the equilibrium level, and that's where there was a freeze happen and all that changes happen. But looks like, based on my understanding, what is happening is you're going back again to the same scenario where after 10 years, again,
you will have the 2.5% escalation, and when the renewal will happen, the older and newer tenancy will have a different rate. How are you accounting for that, where the genesis of this problem started? So any clarity on that front will be helpful. Secondly, on the receivable, can you explain how does the movement will happen on it in future, or other way, till when date, in terms of date, you have kind of provided provisions for the VIL receivable? That is number one. In future, how should we think about the movement on the receivable side? If there is a quarterly revenue run rate from VIL, how much are you collecting and how much will add to the receivable? Any clarity on that one would be helpful. Thank you.
Thank you. Thank you, Varun, for your question. Look, I think my understanding of 2016 was a structural correction that was made, in which on one hand we had escalation freeze taking place. On the other hand, we got a 5-year extension of the renewal for a set of tenancies. Obviously, this actually also brought in the concept of the rate list as well. However, it was very clear within the MSA framework as well that these tenancies will expire in a period of time which we've been actually transparently sharing with you, that by March 2022, almost a third of our tenancies were to expire, which they did. I would say that under the current circumstances, there was no other way than kind of engaging with the customers and negotiating a great deal, which we have managed to do. I do believe that we have, under the circumstances, a great deal in which we have secured this for another 10 years. For an infrastructure business like this, I think it's sealed for a good period of time as well. Now, please put yourself in shoes wherein you were to negotiate a deal like this, where you are negotiating with customers, and I think the difference between the balance sheets of each of these customers and Indus Towers, there is a truckload of gap as well. And in that context, I think where we stand with the kind of impact Vikas has spoken, I think this is a great deal which we have secured, not only for Indus Towers but for the industry itself, because whatever we end up doing actually becomes industry benchmark. I think 10 years is a great period of time as well. I do believe that whatever impact we have, let's put it this way, with accelerated 5G rollout, with the newer sites coming in, I think we should be able to swallow this within, let's say, year and a half, and we have clear 7.5 years of growth. Please remember that this 2.5% escalation year on year is a great thing to happen, and I think there is no way this model will get changed or get worse from here on. I think it is a great model which has delivered in the past. So I think we certainly have come out clean with minimum or no change to the model. So I'm, as CEO, Managing Director of this company, I am very happy that we have secured this under very, very difficult circumstances, not only for us, but for our customers as well. And good that we've done it for both the customers. And as you would know, both the customers are in a very different frame when it comes to their financial position. On the second part, Vikas, maybe you can take up.
Yeah, sure. So hi, Varun. So I think your question, just to sort of recap the question, your question is how do we really see the receivables sort of moving going ahead? So I mean, first of all, I would want to start with saying that, I mean, if you look at the trend in the last couple of months, because of various reasons, if we just keep aside the security money that we received, then excluding that, we have been getting payment of roughly 50 to 60% in the last couple of months of our monthly dues. And We have also basically, from public domain and from the information that we have, know that the customer has a funding plan which is in discussion with its lenders, and that will have a huge bearing on their cash flows and their ability to invest and so on. So the payment plan, like I said, we have received still indicates that they won't be able to make the full payment of monthly dues till December 2022. In which case, if that happens, then directionally we can expect that the receivables will go up further. And in which case, like I said, we will continue to assess the situation, and wherever we see the account receivable risk developing, we will make the necessary provisions to do adequate de-risking of the situation. So I think the simple answer is movement-wise, while I said we are discussing and trying to work out a better plan, but given the current indications, it seems like it will go up for a couple of months.
Okay, thank you. The last question was for the provision that you have provided. Till what date, any month, by when those provisions you have made in terms of account as a bad debt?
Again, that's dependent on the policy that we have, which is different for different customers. So again, it's a bit of a customer-specific information. We may not be able to reveal that, Varun. But I can assure you that this is based on a stringent approach that is discussed and assessed, and then we make those provisions. If required, we will take another position and make it more stringent if required going forward.
Okay, thank you.
Thank you.
Thank you very much, Mr. Ahuja. The next question comes from Mr. Ankit Patel from L&T Mutual Fund, Mumbai. Mr. Patel, you may ask your question now.
Yeah, thanks for taking my question. Good afternoon. I had two questions. One was, you mentioned that you expect to receive part of the payments till December. What, if you could at least, if you could quantify what part of the payments, I mean, what, if there's a range in terms of how it will be received. And the second question is regarding the other customer. How are the payment? How is the payment going on, and whether there is any changes in the payment track record over there?
Yeah. So Ankit, I think as far as the quantification of the part payment is concerned, I think the pretty much the past trend that I spoke about, wherein excluding the money that we received as part of the security monetization, otherwise we have been getting roughly, like I said, 50 to 60% of our monthly dues. So that is a good indicator of the sort of part payment we can expect going forward, subject to whatever discussions we are going to have in terms of bettering the payment plan. So I think that would be a good indicator. Other customers, I don't think we have major receivables issues, except for one non-JV customer where we have some old age outstanding, but that sum is not very material. And in any case, we are working with that customer as well to expedite the payments and recover those dues. So that's where we are.
Right. Okay. Thanks. Thank you.
Thank you.
Thank you very much, Mr. Patel. At this moment, there are no further questions from participants. I will now hand over the call proceedings to Mr. Bimal Dayal for the final remarks.
Thank you. Thank you, Rajita. I think it's fairly nostalgic for me. Let me first thank pretty much all my able partners in Vikas and Dheeraj for doing a commendable job. I would certainly like to thank our field force, the management committee members, Indus family, shareholders, and the board members of past and present boards. A very special thanks to Mr. Kumar, our current chairman, who has been the biggest support. Pretty much thank you all for joining and making this a great interactive session. I think there is, besides responding, there is a great learning as well. So thank you for keeping it alive. Logging off with my best wishes to all, with a conviction that the newer leaders will take this great company to greater heights as well. Thank you very much. God bless.
Ladies and gentlemen, this concludes the conference call. You may now disconnect your line. Thank you for connecting to audio conference service from Airtel and have a pleasant evening.